I want to ask you about an essay that you published a few days ago about PayPal, which is a company you worked for more than a decade ago. The company, of course, appointed a new CEO earlier this week, and the stock has fallen dramatically since that announcement. And broadly speaking, it's been on a bit of a drawdown for the last couple of years since its pandemic highs, at least. You published this essay, and you ended it by saying the company that had every advantage and could have become the most consequential and relevant payments company of our time lost its mojo, its product edge, and its ability to compete. Why did you decide to write this essay now?
Look, I mean, this is a company that I gave a lot to and that I care deeply about. I took the helm in 2012, early 2012. And at the time, the company was already like in that trajectory of having a lot of consultants, having offshore development, having lost its technology edge and its innovation juices. And I found a number of really great, talented people within the organization. We completely changed the culture. We were really on a tear. We acquired Braintree and Venmo, and the growth really accelerated at the time, and it felt like the company was on the right trajectory. And after that, I feel like, you had a succession of different leaders that actually just decided to just ride the wave that the company had and the network effects, basically, and try to optimize the company financially rather than continue to innovate and continue to push for products in the face of a tremendous amount of innovation, right? It's like, this was the time where Apple Pay was really growing at a rapid pace, taking away PayPal's most valuable customers from checkout experiences. They decided to focus on unbranded checkout, which is basically just card processing, which is super commoditized and low margin, versus the branded flows that could have been made better, faster, more mobile friendly. And on lending, they completely missed the mark at the time where you really had Affirm and Klarna and Afterpay being built, and then they acquired a bunch of companies that made no sense to acquire or to be part of PayPal, and so all of this basically just eroded the company's place in a market that was being reinvented. And I sat on this feeling, being frustrated by the sideline for years, and felt like I really didn't want to do armchair commentary. And I ejected myself out of this company, and I felt like it wasn't my place to comment. But like after 12 years, I felt like that was enough time, and I felt frustrated enough to speak up.
I want to go back to the start, though. The initial advantage that you think PayPal had that it didn't really make use of. What was that advantage at the start?
Well, look, I mean, if you think about two-sided payments networks, there are really only a few, right? I mean, there's definitely, Visa, there's MasterCard. Visa sits at the center between acquiring and issuing banks that touch consumers, acquiring banks that touch the merchants. Amex has the two sides of the network themselves as a first party. And then, since those networks were built, PayPal was really the first and last shot at a company at building a two-sided payments network at a global scale. It had consumers, it had merchants, it could clear transactions between consumers and merchants in real time on its ledger. And so it had every advantage to build a closed payment network that was the most efficient. And Elon Musk always talked about X and his vision for PayPal at the time, X Money,
Right.
at the time, as like a giant database where basically if you have the largest database and you can move value on your own database, then you're more efficient than everyone else, and then you win. That
Right.
was kind of the original premise for PayPal, and they completely missed the mark.
Now, you talk about how over the course of the company's history, they prioritize payment volume as opposed to prioritizing product and the experience that customers go through. I wonder, was it your experience? Was that clearly the focus on the ground? From what, and you weren't at the company over this time, so this is all reflection. But I guess, was that explicitly the focus in the moment, or is that something that, in hindsight, that appears to have been what happened?
I mean, I think, I don't know for sure because I wasn't inside the company, but I think it's really clear that they focused on trying to do more card processing and more unbranded volume as a way to show growth to the street and, report earnings quarter after quarter
Hmm,
and optimize for short-term upside.
hmm.
And then, of course, like, the online shopping boom that COVID fueled clearly helped them hide the realities of losing share of checkouts to Apple Pay and others, and also losing share to BNPL products and buy now pay later products and others. And so it looked better than it actually was under the hood for a while.
Right. Now, if you mentioned a few opportunities in your essay: branded checkout, lending, buy now, pay later. Which of those do you think could have been the biggest opportunity for PayPal?
Well, I mean, look, it's like really branded checkout, like the two-sided network is
Right.
really where all of the money was. Like and I mean, we had like a healthy tension between the card networks and PayPal for the longest time because PayPal used to do something that card networks hated, which was called steering. Basically, you have a bank account that's connected to your PayPal account, and you have credit cards, and then you try to steer as many transactions as possible to bank because then you can arbitrage the cost of an ACH pool that you underwrite for instant payments, and the payment that like a merchant is paying you 300 bips or so for, and that was where all of the money PayPal was for a very long time. And I think the team at Visa masterfully played PayPal at the time to actually get them on a sort of gravy train for a few years for that to look good on the street, but then force them to stop trying to get a better funding mix from PayPal's economics, which was also long term very very bad, but short term maybe felt good. But definitely Visa played that way better than PayPal did back in the day.
So, what would you do now?
Yeah. I mean, look, I think that it's really clear that there's a governance problem at the company, and the board is it's more or less a collection of professional board members, some of them who've been there for a long time, and so I think for anyone taking the helm there. First of all, you need someone who understands payments deeply. I think that's like really critical, and then like that person needs to have enough skin in the game and have like close to dictatorship type of authority to actually really revamp the company and rewire it from the inside out, which is kind of an open heart surgery. But yeah, I mean, it won't be easy to actually get someone who has the skill and the right structure from a governance and incentive standpoint to actually go do that work.
Did they ask you to come back at all?
No.
Any interest?
No, no, I'm good. Like, look, Lightspark is on a tear.
Lightspark is
We're
keeping you
doing
busy.
great. Like, it's amazing. It's going to be an amazing company that's going to be foundational for how money moves in the long term. I'm
Right,
having a
right,
blast. It's still a startup 3.5 years in. I'm having the
right.
best time. So no interest.
Let me ask you one more question before you go, which is that look, I mean, the PayPal's performance over the past few years. I mean, you look at the performance of recently IPO'd fintech companies like Chime, like Klarna, even
Mhm.
Wealthfront. I mean, this is a group too that has not performed as well as I think many would have hoped since their debuts. What do you make of this broader fintech drawdown in stocks?
Well, look, I think just fintech in general, like for years, it used to be, I like to say that it's not the most glorious way to describe it, but it used to be what I think is lipstick on a pig, right? It's like, it's still the old, bad, non real time infrastructure, and you're just putting a veneer of a cool looking app on top of it without rewiring the underlying infrastructure. And so I think like you can do that and get customers and decent economics, but if you don't actually have like better rails for all of these things that are being rebuilt right now on top of crypto rails and blockchains and real-time settlement engines, if you don't do that, then like your advantages are not going to be long-lived. And I think there are a few other examples of very successful companies like Revolut, that has done really well, of course, and more than all of those, Nubank that I have the honor of sitting on the board of. that has really core technologies and capabilities that I think very few other players have and have been able to like really take advantage of. And so I think it's kind of a tale of two cities. You have those that have really like the core technologies to have a competitive, long-lasting advantage, and those who've built like on top of legacy infrastructure and are just like offering a better consumer or business experience.
Hmm. Great. Well, David, I want to thank you for coming on. That is David Marcus, co-founder and CEO of Lightspark here on TITV.